The price you see on the screen is losing its authority, and physical silver is the one voting, loudly, by refusing to show up at market price. That's the conflict nobody wants to say out loud because it exposes how fragile price discovery gets when liquidity thins and inventory stops being a number and starts being a decision. And here is the hidden mechanism mainstream commentary keeps missing. When the spread between paper and replaceable deliverable metal widens, the spot price can stay calm for a few hours while the real market is already in triage. Stay with me, because by the end you'll have a concrete next week checklist, 2 scenarios you can actually trade around mentally, and the one level that changes the math if it breaks. Yesterday, I tried to buy silver, not in theory, not in a spreadsheet. In the real world, where metal has to be sourced, hedged, insured, moved, and replaced, 3 different dealers refused to honor what most people would call the market price. And before anyone turns that into a cartoon conspiracy, let Wes make this precise. A dealer refusing spot is rarely a dramatic villain moment. It's a risk management moment. It's a sentence that means, I cannot replace this inventory at the reference price you're requoting without taking a loss. I can hedge fast enough. Well, and that one sentence tells you more about stress in the supply chain than 1,000 hot takes. Because when a dealer taps out, it's not because silver disappeared from Earth overnight. It's because the chain between paper and physical is under tension, and somebody at the end of the chain is choosing survival over volume. And that's where the real pressure starts. If you've been watching silver this month, you already know why dealers get twitchy. The tape hasn't been polite. We've seen silver swing from the low 70s per ounce at the start of January to prints in the 80s, then back into the mid to high 70s in days. That isn't normal commodity volatility. That's the kind of volatility that forces every participant to change behavior, not opinion. It changes how wholesalers quote. It changes how dealers hedge. It changes how much inventory they're willing to put on the counter. It changes whether they widen premiums, shorten quote windows, or just pause and say, call back later. And here is the part that matters. Those behavior changes show up first in the physical market, because physical is where replacement cost lives. Paper can trade all day on expectations and positioning. Physical has to be replaced, and replacement is not a thought experiment. So what does it actually mean when a dealer refuses market price? Think of spot as a reference rate, like a headline interest rate. It is not the same thing as the rate you personally get when the pipes are clogged and everyone is trying to borrow at once. The dealer isn't saying silver has no price. They're saying the price you're quoting isn't clearing real replaceable inventory in that moment. In a calm market, the dealer sees spot, adds a premium, locks a hedge, and sources replenishment. In a violent market, the dealer's hedge can slip, their wholesaler can widen, their pipeline can delay, and the risk of being short physical while the price gaps higher becomes existential. That is the moment spot stops being a promise and becomes a suggestion. And that's not a story, that's mechanics. Now, here's the first proof layer, and that's important because it keeps us grounded. Silver's volatility has not been subtle. Implied volatility in silver options has been elevated, and you can see it in how quickly the market whips through ranges. When implied volatility is high, dealers aren't just betting on direction. They remanaging the probability of getting hit during a fast move. The moment volatility spikes, quote, windows shrink, premiums become elastic. And a dealer refusing to honor spot is often a dealer refusing to be your free option. Because that is what a tight premium and a long quote window becomes during a fast tape. You were effectively asking them to sell you a call option on physical inventory, and they're saying no. But that's not the part everyone should be watching. The next detail is what flips the whole setup. The hidden detail is the spread. Not the headline, not the tweet. The spread between paper pricing and the cost to source deliverable metal where it's needed. When the world is functioning smoothly, arbitrage keeps those spreads tight. If New York is paying more than London, metal moves. If futures are expensive relative to spot, the curve pulls supply forward. If retail demand spikes, premiums rise a bit, then supply responds. But when metal is stuck in the wrong places, those natural shock absorbers stop working on schedule. And when they stop working, the first thing that breaks is trust in the reference price. That's why 3 dealers refused spot matters. It's not the number of dealers, it's the message. Replaceability is impaired. And if replaceability is impaired, paper and physical can decouple. Not forever, not in a magical way, but long enough to create violent air pockets in price. And if you've ever traded a market that goes illiquid, you know what that means. The move doesn't feel like a move. It feels like a gap, because if this one level breaks, the math changes. Let me make the chain visible, because most people talk about silver like it's one market. It isn't. There's paper price discovery, futures, options, OTC forwards. There's physical wholesale, large bars, vault-to-vault transfers, industrial supply agreements. There's retail, coins, small bars, fabrication, shipping. And the friction between those layers is where the story lives. Paper trades in seconds, physical trades in schedules. Paper can be netted and offset. Physical has to be delivered, fabricated, and financed. Paper has margin. Physical has inventory carrying costs. And crucially, physical has categories. This is where the inventory optical illusion shows up. You've probably seen people throw around warehouse stock numbers like it's a scoreboard. There are hundreds of millions of ounces in approved warehouses, they'll say, so there can't be a shortage. That's a surface level interpretation. The deeper question is, how much of that inventory is actually deliverable at today's price on today's timeline without forcing someone to give up metal they don't want to sell? In the exchange world, inventory gets categorized. There's metal that is registered for delivery, and there's metal that is eligible, meaning it meets specs and sits in an approved facility, but it is not necessarily committed for delivery. That difference is not semantics, it's liquidity. Eligible can be a museum, registered is the storefront. And in stress, you learn very fast that a museum does not save you when the storefront is empty. Now add the second proof layer. Inventory can be big and still not be available. Total warehouse stock can be hundreds of millions of ounces, while the slice that is effectively for sale at current conditions can be much smaller. And even if registered stocks look okay in absolute terms, the market can still get tight if the marginal owner refuses to sell. Because markets clear at the margin, not at the average. The owner of those bars might be a fund hedging something else, a bank managing collateral, an industrial player building buffer stock, or someone simply waiting for a better price. If they don't want to turn it into deliverable supply, you can't force it without raising the price. That's not a conspiracy. That's literally how price works. But that's not the part that matters most this week. The calendar is. The why now is early January. And early January has two nasty features people underestimate. First, liquidity is thinner than it looks because the market is coming back from year-end positioning and not everyone is immediately active at full size. Second, major funds that track commodity indices often have rebalancing windows right around this time. That creates forced flows, selling or buying that has nothing to do with opinion and everything to do with mandate. If a big chunk of index-linked money is required to reduce exposure in a narrow window, it can pressure futures prices even while physical tightness remains. And that's the perfect recipe for confusion. Paper prices dip on forced selling, while physical premiums stay firm because replacement is still hard. That divergence is the kind of thing that makes dealers refuse spot, because they are looking at replacement cost, not the tape. And if you don't understand that, you'll think the dealer is ripping you off, when in reality they are refusing to become the liquidity provider of last resort in a market that's whipping around. So here's what likely happened in my three dealers moment in plain mechanics. Dealer A watches the screen and sees futures sliding fast. They call their wholesaler or check their wholesale feed. The wholesale premium widens because wholesalers see the same volatility and they protect themselves. Dealer A tries to hedge by selling futures. But in fast tape, the hedge is not a perfect lock. Slippage exists, and margin requirements matter. Dealer A also knows that if the price snaps back higher, replacing the inventory they sell to me could cost more before their hedge settles out. So they either widen the premium to absorb the risk, or they refuse to quote at spot-based pricing. Dealer B has inventory but has been waiting on restock. Their delivery window is longer than usual because fabrication capacity and logistics have lead times. So they ration inventory. Dealer C is watching demand spike at the same time as supply is uncertain and decides, I'm not selling the last of my stock at a premium that made sense last week. Different reasons, same outcome. The reference price doesn't clear physical supply, and that's the signal. Now let's stack proof point 3 because this is where the story stops being my dealer anecdote and becomes macro-mechanical. We have a real-world situation where silver has been described by major banks as being stuck in the wrong places. Translation? The global distribution of accessible silver inventory matters as much as the total amount of silver. If metal has migrated into U.S. vaults for reasons like policy uncertainty, tariff fears, or financing incentives, then the liquidity of metal in the London system, the benchmark reference world, can tighten even if global inventory hasn't T-collapsed. And when the benchmark pool tightens, the cost to source and settle in that pool can change quickly. That's when spreads begin to scream even before spot does. And if you only watch spot, you miss it. Everyone's watching the headline, but the signal is somewhere else. Proof point 4 is the term structure vibe. You don't need a PhD to use it. When a market is comfortable, forward prices often trade with a mild carrying cost story. Storage, financing, convenience yield. When a market is stressed for immediate supply, nearby contracts can trade firm relative to deferred contracts, or the curve can flatten in ways that tell you the market wants it now. Even if you don't have the exact curve in front of you, you can feel it through behavior. Wholesalers shorten guarantees, delivery times lengthen, and physical premiums stop following paper dips. That is a term structure story made physical, and that's where the real pressure starts. Proof point 5 is the retail symptom itself. Dealers refusing spot, delivery delays, tighter quote windows, and premiums that don't collapse even when futures pull back. Retail symptoms are not the cause of the market, but they're often an early warning of friction. Retail is the edge where small inventory becomes visible, and when the edge is tight, it tells you the center is not as fluid as the screen suggests. The trick is not to overreact and scream shortage every time premiums rise. The trick is to understand what kind of tightness it is. Is it fabrication tightness? Is it logistics? Is it financing? Is it location dislocation? Because each one resolves differently, and your timeline depends on the type. Here's the most useful model. Silver can be abundant and scarce at the same time. Abundant in total ounces, scarce in deliverable, immediately accessible, properly located form. That's not a paradox, that's a supply chain. Think about it like water. A region can have plenty of water in the country, but if the reservoir is far and the pipes are constrained, people at the tap still face scarcity. You don't need a global shortage to have a local emergency. You just need bottlenecks. And silver is a market built on bottlenecks: refining, fabrication, vault allocation, financing, and transport. But the next detail is what flips the whole setup. The next detail is how quickly paper positioning can turn into forced buying. Because silver is not a sleepy, deep market compared to something like US Treasuries. Silver can move like a leveraged instrument when volatility is high, and that's where positioning and margin come in. In a fast rally, short positions face increasing margin. If price spikes through key levels, they can be forced to cover into rising prices. That is a reflexive loop, not a theory, a mechanical feedback. On top of that, options can amplify moves. When dealers are short calls, they hedge by buying futures as price rises, delta hedging. If the market enters a zone where options gamma is large, price moves can force dealers to chase, buying into strength and selling into weakness, accelerating the move. That's why silver can look parabolic or then crash without any new information. It's flow, it's hedging, it's margin, it's positioning, it's math. And this move isn't emotion, it's math. Now put the calendar trigger back into this picture. Early January can bring forced index rebalancing flows, selling pressure that can push futures down temporarily. That selling can collide with a market where physical is tight and positioning is sensitive. So you can get a weird sequence: paper dips on forced selling, which tempts shorts to press, which then runs into physical firmness, and buyers stepping in, which then triggers a snapback, which then forces covering, which then produces the next spike. That is how you get a market that feels like it is trying to throw everyone off the ride. And if you don't have a psychology shield, this is where you get emotionally manipulated. Let's talk about that manipulation, because it's real, and it doesn't require anyone to be evil. Volatility itself is the manipulation. High volatility creates narrative whiplash. One day it's silver is unstoppable. Oh, 2 days later, it's the rally is over. Then it's squeezing again. Your brain wants certainty. The market sells you certainty in exchange for bad decisions. It makes you chase highs when the tape is euphoric and puke lows when the tape is terrifying. And silver is especially good at this because it moves fast enough to trigger fear, but not so fast that you feel it as purely random. You feel like you should have known, which makes you double down emotionally. The shield is simple: separate trend signal from noise. Trend signal is structure, levels, term structure behavior, physical premium behavior, inventory accessibility, macro drivers. Noise is the intraday spike engineered by positioning and liquidity. The thesis can be correct, and price can still whip violently against you. You need to expect that. You need to plan for that. Because if you don't, you'll be right and still lose your nerve. Now, let's ground this in macro and supply chain, because silver is not just a shiny coin story. Silver is industrial. Solar, electronics, electrification, various high conductivity applications. That demand can be sticky and price inelastic in certain windows because manufacturers can just halt production because silver spiked 5% today. They hedge, they procure, they keep buffer stocks. And when price is volatile, procurement behavior changes. Some buyers accelerate purchases to avoid being caught short. Others pause, hoping for dips. That creates lumpy demand. And lumpy demand in a market with bottlenecks creates stress. Add the supply side realities. Mining is not a faucet. A lot of silver supply is a byproduct of other mining: lead, zinc, copper. That means silver supply does not respond instantly to higher silver prices. It responds to broader base metals dynamics and investment cycles. Recycling exists, but it has lead times and constraints. Fabrication capacity, turning large bars into retail products, has capacity limits. Shipping has constraints. Insurance has constraints. Financing has constraints. That's why paper says one thing, physical says another. It can happen during stress windows. But that's not the part that matters most for next week. Next week is about levels and flow. So let's build a simple finance-literate roadmap without pretending we have godlike precision. Silver recently printed in the low 70s, then surged into the low 80s, then snapped back into the mid to high 70s. You also have a widely watched reference area around the mid 70s as a psychological and structural zone. Think of it as the do we still have buyers torque level. Above that, the market can argue it's consolidating after a shock. Below that, the market invites the rally is over crowd to get louder. And there's a second zone, the 80 handle. The 80s are where psychology changes. Above 80, the market starts forcing new behavior, shorts cover faster, hedgers adjust, and the media turns it into a spectacle. And above the prior peak in the low to mid 80s, you get a different game entirely, because you move from trend into airspace. I mean, the market can do almost anything in airspace. That's where gap risk lives. And that's the payoff I promised. The levels that matter and what the market is forced to do around them. Here are the two scenarios you need, because single track narratives are how you get wrecked in a market like this. Scenario 1 is the controlled pullback and retest. Futures remain choppy, maybe pressured by forced selling flows, maybe by risk-off liquidation, but physical premiums do not collapse. Dealers may still be selective, but you start seeing quotes normalize. The mid-70s area holds as buyers step in. The curve stabilizes. Volatility stays high, but starts to compress slightly. In this scenario, you're not looking for straight line upside. You're looking for basing behavior. Or you're looking for the market to absorb flow without breaking structure. If that happens, you can get the next leg higher later, but the market needs to rebuild trust first. And that's where the real pressure starts, because rebuilding trust is the opposite of chasing. Scenario 2 is the continuation squeeze. Paper dips get bought hard. The market refuses to stay below the mid to high 70s for long. You see quick rebounds. Volatility remains elevated. Dealers remain cautious. Premiums stay firm, and any headline that triggers safe haven demand or policy uncertainty can spark another burst higher. If the market reclaims 80 decisively and holds it, the odds of testing the prior highs rise quickly. Not because of mystical reasons, because of positioning and hedging mechanics. Above 80, the market tends to force participants into shorter decision windows. Shorts cover, options hedging chases, stop levels trigger, liquidity thins. That S, when you get a move that feels like it S happening to people rather than for them. And if it pushes into the low to mid 80s again, you get the situation where the market starts pulling forward demand and inventory decisions. That's when dealer refusals multiply. That's when paper and physical tension gets loud. But that's not the part that matters most. The invalidation is. What invalidates the physical veto thesis, at least near term? Two things. First, a meaningful collapse in physical premiums and retail tightness symptoms, while paper prices also soften. If dealers suddenly have no problem sourcing, quote, windows widen, delivery times normalize, and premiums compress materially, that tells you the tightness was largely a volatility and fabrication event that is resolving. Second, evidence that the location dislocation is healing, metal flows back to the benchmark pool, liquidity improves, and the spreads relax. In that world, paper can fall without physical pushing back because replaceability improves. You can still have a longer-term bullish case for silver and still acknowledge that the near-term squeeze setup is fading. That's credibility. That's how you avoid marrying a narrative. Now, let ES bring in one more proof layer that people ignore because it sounds boring, vault data and transparency signals. We know that large vault centers report aggregate holdings. Those holdings can even rise month to month. That does not automatically mean stress is gone. It can mean metal moved into vaults for collateral. It can mean metal was reclassified. It can mean metal is allocated and not for sale. So the right question isn't, is there metal? The right question is there fluid metal? Because fluid metal is what arbitrage needs. If fluid metal is low, the market becomes more sensitive. And when a market becomes more sensitive, small changes in demand produce outsized changes in price. That is why you can see enormous price swings even if investor demand is not excessive by old metrics. The market's sensitivity changes. That's a structural regime shift. And once sensitivity increases, volatility becomes the tax everyone pays. Now, I want to address the skeptical viewer directly because you're the one this video is for. You don't want slogans, you want mechanisms. So here's the clean, evidence-driven interpretation of 3 dealers refuse to honor spot in one line. The marginal unit of physical silver is being priced at replacement cost under stress, not at the screen's reference print. And that divergence is a classic sign of a market where liquidity and location are more important than global supply totals. That's the thesis. But the market doesn't pay you for being right. It pays you for managing the path. So here's your next week checklist, the one that beats opinions. Watch whether silver can hold the mid-70s area on closes, not on wicks. Wicks are emotion, closes are commitment. Watch whether moves below that zone are quickly rejected or whether price starts living below it. Watch the behavior around 80. If 80 becomes a ceiling that repeatedly rejects price, that's telling you the market is cooling. If 80 becomes a floor that holds, that's telling you the squeeze risk is alive. Watch volatility behavior. If implied, volatility stays elevated or rises as price rises, that's often stress buying, not calm trending. If volatility starts to compress while price holds structure, that's healthier. Watch physical availability symptoms in your own world. Quote, windows, premiums, delivery times. Not because retail is the market, but because retail is the edge that reveals friction. Watch for forced flow windows, this week's rebalancing activity, and any scheduled events that could thin liquidity. And finally, watch for the one metric most people ignore, the spread between what you can buy on paper and what it costs to source deliverable metal now. Because when the price is lying, the spread tells the truth, and that's where the real pressure starts. Now, the psychology shield. This is the rule you tattoo on your brain in silver. Volatility will try to make you quit at the exact moment the thesis is most alive. It will do it with a gap down that feels like it's over. Then it will do it with a face-ripping rebound that makes you feel stupid. Then it will do it again. Your job is not to win every candle. Your job is to define your horizon and your invalidation, and then let the market thrash without stealing your identity. If you're a macro watcher, you already know this. Markets don't move to be fair. They move to force behavior. That's what high volatility does. It forces weak hands to hand over inventory. It forces leveraged positions to close. It forces hedgers to adjust. It forces narratives to flip. And if you understand that, you stop letting headlines push you around. So what do you do with this, practically, without turning it into reckless advice? You treat silver like a volatile asset with two timelines. On the short timeline, it's a positioning and liquidity instrument that can gap and whip regardless of fundamentals. On the medium timeline, it's a market with real supply chain constraints, location dislocations, and industrial demand that can create repeated stress episodes. Those timelines can conflict. That conflict is the opportunity and the danger. Scenario 1 is you get a controlled pullback, premiums stay firm, and the market rebuilds. Scenario 2 is you get the continuation squeeze, 80 turns from a ceiling into a floor, and the market takes another run at the highs in the low to mid-80s. In both cases, the risk is the same, overconfidence. In both cases, the edge is the same, understanding what the market is forced to do, not what you hope it does. And now let's close this the right way, with a subtle identity check rather than begging. If you're still here, you're not here for dopamine. You're here for mechanism and truth. You're the kind of investor who watches structure, flow, and supply chain reality, not just the headline print. That's rare. And it matters, because markets like silver punish the crowd and reward the disciplined. So this week, don't argue with the chart. Don't argue with the dealer behavior. Don't argue with spreads. Watch them. Let them tell you which world you're in. Because the moment physical refuses to clear at the screen's reference price, you've been handed a signal most people will never even see. And the next detail, whether 80 holds or fails, is what flips the whole setup.